Foreclosures across California are up 22% year over year, and median home prices in cities like San Diego and Sacramento have already dropped by over $40,000 since their 2022 peaks. The question is this the perfect storm or the best buying window we've seen in a decade? Because when the market crashes, cash is king. And right now, institutional players are circling distressed inventory like sharks. In this video, we're diving deep into the 2024 to 2025 housing cycle. You'll discover which U.S. metros are hitting bottom first, where rental yields are quietly spiking, and how to position your portfolio before the recovery begins. Stay with me, because in just a few minutes, I'll show you where the smart money is moving before the next wave of buyers returns. Let's start with where we are right now. Across the U.S., we're seeing what I'd call an asynchronous correction. Markets like San Francisco, Austin, and Boise are already 10 to 15% off their pandemic peaks. Meanwhile, legacy metros like New York and Chicago are holding firm. But that's only half the story. Look at this chart. Median home price decline, top U.S. metros 2023 to 2025. You'll notice cities like Phoenix, Las Vegas, and Sacramento leading the pullback. These are the same metros that saw outsized gains during 2020 to 2022, and now they're cooling fastest. So, what's driving it? It starts with affordability. The NAR's affordability index dropped below 100 in early 2024. Which means the typical U.S. household can no longer qualify for a median-priced home. That's not just a stat, it's a sentiment shift. Buyers have hit a wall, and in many metros, so have investors. Meanwhile, interest rates are holding stubbornly high. The Fed's target range remains between 4.5 to 5%, and mortgage rates continue to hover near 6.7%. Even seasoned investors are feeling the cost of capital. You know how this works. When money gets expensive, patience runs thin. But that's just the macro view. The deeper story is in the inventory. Look at this chart. Active listings growth, U.S. Sunbelt cities 2023 to 2025. Inventory levels in markets like Tampa, Charlotte, and Dallas have jumped by 20% or more. Not because of new construction, because properties are sitting. Sellers are holding out for yesterday's prices. Buyers, meanwhile, are on the sidelines, waiting for capitulation. This standoff is creating the illusion of a stable market, but underneath, stress is building. And that's where foreclosures come in. According to Adam, foreclosure filings are up 20% year over year, with hotspots in California's Central Valley, parts of Texas, and suburban Florida. In fact, in Riverside County alone, over 2,000 filings were recorded in Q1 2025, nearly double the count from last year. And when that pressure breaks, opportunities follow. Now here's what most investors overlook. Not all markets crash at the same time or recover at the same speed. Take Austin. Prices there corrected nearly 12% in 2023, but demand from high-income tech workers and institutional buyers has already started stabilizing the rental market. On the other hand, parts of Las Vegas are still in freefall, driven by second home sellers and short-term rental oversupply. And consider this: rental yield spread, coastal versus inland metros 2025. Inland metros like Indianapolis, Birmingham, and even parts of Tampa are posting 6 to 7% rental yields, while coastal cities barely break 3%. This is a massive divergence, and smart capital is already shifting. Later in this video, I'll walk you through 3 metros showing the clearest signs of bottoming and the highest cash-on-cash yields in the country. So where's the smart money going? Institutional players are already active. Blackstone has quietly ramped up acquisitions in Atlanta and Charlotte, targeting SFR portfolios under $500K Starwood capital. Meanwhile, reallocated $1 billion into distressed multifamily assets in the Southwest, leveraging their liquidity to close at 15 to 20% discounts. You know what they say? If you're waiting for the bottom, you may already be too late. From what I've seen watching the California market since 2020, the investors who bought during uncertainty, not clarity, captured the best gains. They weren't relying on timing perfection. They were focused on execution. Let me give you a real-world example. An investor I work with acquired a portfolio of 5 single-family rentals in Sacramento in late 2023, just as local prices were beginning to slide. He paid roughly $385,000 per property, all off-market, all with seller concessions. 1 year later, rents are up 6%, and his yield is just north of 6.2%, with refinance potential on the horizon if rates fall later this year. That's not luck. That's disciplined buying in a distressed window. Now let's talk strategy. If you're a cash buyer, this is your moment. The best plays right now are distressed SFRs in secondary metros, assets under $500K, ideally off-market or REO. These are often overlooked by institutions focused on scale, but for individual investors or small funds, they're gold. Close fast, negotiate hard, and structure with long-term tax efficiency in mind. U.S. investors should be looking at 1,031 exchange opportunities. For UK, Canadian, or Australian investors, careful entity planning can help mitigate FIRPTA, CGT, or SDLT burdens on exit. Don't ignore build-to-rent. BTR is still in its early innings in the U.S., but developers are sitting on entitled land and paused construction pipelines. Partnering with a mid-sized builder on a distressed land deal could set you up for 8 to 9% unlevered returns, if you structure the leaseback right. Look at this chart. SFR institutional share versus yield by metro, Q1 2025. In metros where institutional ownership exceeds 10%, SFR yields are more compressed. But in cities like Oklahoma City, Memphis, and Raleigh, yields remain elevated, and ownership is still fragmented. This is where private capital has the edge. So what comes next? J.P. Morgan is forecasting a 5 to 7% additional decline in national home prices by Q3 2025 if unemployment ticks past 4.5%. Meanwhile, CoreLogic predicts a bottoming process in key metros by late Q3, assuming mortgage rates normalize below 6%. In short, we're approaching the inflection point, and while most buyers wait for the signal, institutional capital is already moving. Don't follow the crowd. Lead with data, execute with discipline, and structure with tax in mind. Coming up, I'll break down the 3 metros, showing the clearest signals of price recovery, rental strength, and entry opportunity. You'll want to catch this, because if you're not positioned early, you're already behind. And before we wrap up, I want to leave you with one last strategy that's proving incredibly effective for investors navigating this 2025 market, especially in cities still digesting the last 2 years of volatility. It's what I call buying into the liquidity gap. This happens in markets where listings are rising, but transaction volumes remain thin, creating a window where sellers are motivated, but institutional buyers haven't returned in full force. Think Riverside County, parts of Tampa, or the edges of the Dallas-Fort Worth metro. If you can move fast, underwrite confidently, and close with minimal contingencies, you're operating in a space where very few can compete. Take a look at this chart. Housing inventory versus buyer demand, U.S. major markets, 2024 to 2025. In Phoenix and Sacramento, for example, active listings are up more than 25%, while pending sales are still lagging. That disconnect is exactly where value gets created, and smart capital knows it. From what I've personally seen working with investors in Austin and Las Vegas, the ones who acted in early 2024, when the headlines were all fear, are now sitting on 6 to 7% yields and double-digit equity cushions. You know how fast things move in this market. Waiting too long can cost you, not just money, but positioning. So let's recap what really matters for investors like you. First, foreclosure rates are up across the U.S., but with them come real opportunities to buy quality assets at a discount. Second, Institutions like Blackstone and Starwood are already building positions in high-yield metros. That's not noise, that's signal. Third, timing matters, but execution matters more. Cash buyers, tax-savvy structures, and geographic focus are how investors are staying ahead. Fourth, recovery signs are already showing up, especially in metros with strong rental fundamentals and population inflows. And fifth, the window to act is narrowing. The best deals rarely come with a flashing sign, they come quietly in the uncertainty. So ask yourself, which U.S. housing market do you believe has the strongest upside in 2025? Are you buying now, or are you still waiting on the sidelines? Let me know in the comments. I want to hear your take. If you don't want to miss the next wave of profitable real estate opportunities, hit that subscribe button now. Like this video if you found it valuable, and share it with anyone serious about strategic investing in U.S. real estate. This is EstateScope, where data meets disciplined strategy. I'll see you in the next one.